Good morning, everybody. Glad you're here with us this morning. Hopefully, this is working out just fine for us. We're going to talk about finance options this morning, and welcome with us from the Small Business Association Administration. John Veal is with us, and Dustin Allen has joined us so far. And we'll also be having Larry Weatherford pop in and out from SBA as well occasionally throughout this conversation this morning. So I'm going to actually go ahead and just kind of kick it off and get it started. And again, thank you for being here. Thank you for our three guests definitely being here to help us get going and hopefully answer a few questions that I know many of you have, and that is getting financing for your business. What do we need to do, and how do we need to go about doing it? So I'm going to go ahead and turn it over to John, let him do some introductions, and we'll go from there.
Good morning. I'm John Veal. I'm the District Director for the Oklahoma District Office of the U.S. Small Business Administration. So you sit there and you ask yourself, what is SBA? What is the Small Business Administration? Basically, we are the primary resource for small businesses looking to start, grow, expand, or recover. So I would say that if you're looking at going into small business, or if you already have a small business, if you need any type of assistance for your business, we should be the first call that you make. We do programs both in general counseling, government contracting, and today we'll go more into depth about our loan programs. So as you can see, that covers everything that a small business would want to do. And so I would submit to you that as you come up with questions, are you looking for assistance or advice, definitely give us a call so we can step up to the plate and help you make your business more successful. That being said, I'll turn over to my lending expert, Dustin Allen, who has a wealth of knowledge in this field, and he's been in this job for a couple of years at least, so he knows what he's talking about. So, Dustin, it's your show.
Okay. First off, am I muted? Because that happened earlier. So everyone can hear me?
You're good.
Good deal. So, John, thank you, and happy to be here and talk to you guys. So, as John stated, one of the common concerns a lot of borrowers have, not borrowers. I'm going to go ahead and preface this. I'm going to say borrower a lot because primarily I'm talking just to borrowers. I'm just talking to lenders. So I mix up business owner and borrower quite a bit. So I'm going to turn my slide deck over here in a second. But what we're going to talk about today is most new businesses or entrepreneurs, the biggest problem they run into is going to be, how do they actually finance their business? There's actually quite a few different options. Obviously, we're partial to the SBA programs because that's why they pay us to be here. But there's quite a few different options out there, from borrowing traditional money to different crowdfunding options, things along that line. So today we're going to kind of touch on sort of the basics of all your different options as far as small business financing is going to go. We'll obviously put sort of a focus on what you as veterans will be able to take advantage of through various programs, but it's sort of a general information. And if you have questions during this or questions after this, we can go into more detail as much as you want. This is really designed just to kind of give a basic entry-level understanding of sort of what your options will be whenever you start to look at financing your small business. So I will also say farther on in here, we're going to reference different things, and the SBA partners with various resource partners such as you folks, and there's a ton of information out here. So if we cover something on here and you're not 100% sure, as John said, if you reach out to us, let us know what your question is, what it is you're trying to get information on, and there's probably someone we can put you in touch with that can kind of help you work through the process. So without further ado, I will try and figure out if I can actually share my screen correctly. So okay. So, okay, so okay, there we go. Sure. Can you guys see the just says financing your business slide deck essentially?
It's not popping up just yet. I see, but let me look. Let me add that to it. There we go. Now you're.
Let's see here. Okay, I'm sure I was doing it wrong somehow. So we're going to go ahead and skip through the first 2 slides here because I tried to get that little video thing before to work, but could not. So basically the first thing as a business you're going to want to look at is sort of the objectives of this particular program is to teach you as a business or an entrepreneur sort of how to identify various sources of financing, what financing options are going to be the best fit for you, and then kind of prioritize them through the life of your business. For instance, you may be looking up front at using some credit cards or, you know what, I'm going to mute that real quick. Some other options that might help you on day one as to where, 5 years in, you shouldn't be using certain methods. So kind of let you know what your sort of life cycle looks like as far as those financing options goes. And then understanding how that's going to change to the life of your loan and then sort of fitting that to your own personal action plan. So typically your action plan as far as a small business goes is going to be that business plan. I am not sure if you guys have worked on that yet at all, or that's something you've looked into, but essentially the business plan is that first step when you're starting a small business. That is going to help you figure out whether this business is going to be something you should be looking at. The way we look at it is the business plan is essentially figuring out whether this business is going to succeed or fail on paper. So before you actually put money into this, borrow money, start investing your time and effort into this, you're going to want to write these things down for 2 reasons. One, you want to make sure that you are using your time, money, and efforts in the right direction to where this business is going to succeed. More than likely, it's not going to be something that fails. You may have a great business idea in your head. That business plan is going to let you sort of parse that out and look at it, non-biasly to figure out whether or not this really will be viable. And then the other reason is whenever you're going to go talk to a lender, talk to an investor, anyone like that, one of the first things they're going to ask for is to look at your business plan. That business plan is going to tell them two things primarily. One, obviously the expectations of your business, sort of what your plans are, and then 2, a lot of lenders will use this as a litmus test, a test to see how serious this person is. I spent quite a bit of time both in retail banking and in commercial lending, and I mean, they're lenders. They make off a commission. Their time is money, so to speak. So what they're going to do is they're going to look at your business plan. If it's 2 pages on the back of a cocktail napkin, they're going to probably think, hey, this guy hasn't put that much effort into it. They haven't put that much research, and not give it too much thought. However, if you've got a detailed, again, it doesn't have to be War and Peace, but if you've got a detailed business plan to go over, present to that lender or that investor, that's going to show them that you've invested some time, you've invested some effort, and you are serious about this. And the more serious you take yourself, the more serious that lender is going to take you, because they're going to put that time into the one that's actually going to pay dividends for them in the end, which is that person that's actually going to follow through on the loan. A lot of times as lenders, what they run into is someone that has a great idea. They make 1 phone call or something, or 2, set up 1 meeting, and then change their mind and go do something else. So at this point, the borrowers at least invested some time. So we go into this more further on, but just that business plan, that is the textbook for your business. It's something you should keep updating on a regular basis. And there's a bunch of different uses you guys can have for it. It's something you should always keep up to date. So now, assuming you have your business plan in place and you've looked at this and you're trying to figure out what your business's financing needs are, it's usually going to fall into one of these 3 pools. Obviously, cash flow challenges. This is the sort of stuff you need day to day. You're keeping the shelves stocked, or purchasing small pieces of equipment, paying your electric bill, paying your utility bills, things along that line. Capital investment. This is your larger purchases. This is buying large pieces of equipment, tractors, pieces of especially pieces of equipment, buildings, things along that line, and lengthy product development cycles. Those will be if you've got like a lengthy R&D process, or say you're doing some sort of a manufacturing business, and you need the money today, but your goal is to be up in 18 months and actually running and manufacturing and producing X number of widgets per day. The programs we have here and we'll talk about today, we'll sort of cover all three of these, and for the most part, all of them are interchangeable with the different programs, but the way you're going to approach them will depend on what is your primary use of these. Because normally you're going to have a little bit of all three of these mixed in with every deal. But if you're looking primarily at cash flow issues, there are some different programs that are more beneficial. As to where if you're looking at capital investments, we've got some long-term programs that might aid you more than doing something as far as like a short-term line of credit. And then finally, the lengthy development cycles. So those, depending on what your need is there, you look more at the equity side of financing your business, which is, we'll cover that in a second, but non-traditional lending. Traditional lenders are going to need something in place as far as a schedule to get paid back at the beginning of the process, not able to fund any sort of R&D or speculation. Now, just building a building, being on deferment, that's fine. But this is more of the other reasons, as far as you're trying to develop a new product, or you've got some sort of a lengthy build time, and you don't know when it's going to be ready. That's where you need to look more at the other side of things, which we'll call equity lending, which is covered here in a sec. So when you're looking at your business plan and you're trying to figure out what your first step is as far as how to obtain this financing, what your business is going to need. I'm going to hammer back on this. The business plan, it should be in that document. You should be able to look at your business plan. That should kind of point you in the right direction of how much money you're going to need, what you're going to need to do with it, where it's going to need to go. So another problem you're going to see quite often, or a pitfall, if you will, when you're talking to lenders, is the question of how much do you need? One of the common answers, and it's, well, you need however much you can get, or how much can you give me is the concern. And in some cases that's viable. In most cases though, in that business plan, when you talk to that lender, you're going to need to provide them with at least a list of a prepared inventory of what you're going to need. I'm going to need $10,000 for working capital because I need to pay these 4 items over the first 3 months until I'm up and running. I need $50,000 for this piece of equipment, and then spell it all out. Don't sell yourself short. You don't want to tell them, well, I can skip by for this, or I can do without this if I need to. Start everything's a negotiation. Start with exactly what you want, exactly what you think you're going to need, and then you guys can work on things down the road. The next question you want to ask yourself is sort of how much control do you need? So primarily, whenever you're starting a business, one of the main reasons you're wanting to do this is you want to be your own boss. You want to be in control of everything. You don't want to answer to a partner. You don't want to answer to a boss, anything like that. That is great, and if you can do that, that is amazing, and you should definitely take the ball and run with it. However, there are going to be some instances where you're going to want to bring on a partner, and that partner may come with more than just financing. One example, restaurants are always the easy one, right? Everyone always talks about, starting a restaurant, everyone knows they're high turnover. So banks are a little leery about restaurants. So say you're looking for a certain amount of money for a restaurant, and you're needing some capital. So instead of just going to the bank asking for money, you may be able to bring on someone in your area who's looking to invest in a small business that has experience. Say you're a great cook, they've got experience on the book side, or they've run a restaurant before, or they're currently a manager at a restaurant, and you guys can partner together. They can bring some capital to the table, and then they're also going to sort of check off some of those things the lender's going to look at, because the lender's not going to just look at just the business plan. And actually, in the business plan itself, you should also address shortfalls or management concerns, such as I don't have any experience running a business. Well, if you can bring on an investor who's going to help you manage the business, they're going to bring some capital to the business as well. You're 2 birds with 1 stone there. The next 3 kind of all grouped together. What's your bargaining position? I mean, that business plan is going to tell you, what you need, where you're at, sort of what your options are, what type of business. All these are different. The easiest way to look at it is what are you wanting to get out of this business? It's not asking what type, like, are you going to be a construction business, or are you going to be a dentist office? so on and so forth. What they're looking at more is this a lifestyle business? Are you trying to figure out, I need to maintain a lifestyle where I have this large a home, this number of cars, and I have this much income at the end of the month? In that case, you might not have to work as much as someone who's looking at the high growth, whose whole goal is to put 5-10 years into this, build it up, sell it, and then move on towards the next project or retire. So have an idea when you're looking at these things what your exit strategy is. Don't just take a 30-year loan out because that's the smallest payment. If you're only going to be in that thing for 10-15 years, because your plan is to sell this thing once it's reached a certain point, keep that in mind whenever you're looking at your financing options. And then the last one, what type of capital is most appropriate? This is completely determined by you, not just by your situation of, looking at it as far as what can I qualify for. It should be sort of what's the best option for me? What's the best option for the business? Do I want to have to make these monthly payments back? Do I want to sell a portion of my business? Things along that line. So we'll skip over this slide. So I'm not going to kind of go over this slide, but if you want to contact me offline, or my contact information info's at the end, I can send something like this over to you. Basically, this breaks down the life cycle of what sort of financing you should be looking at. So when you're at the very far left there, the very beginnings of the business where you've just got the idea and you've really not opened yet, there are different types of funding that you're going to need at maturity, which is where the business is up and running, you fully expanded, you're done growing, and now the business is either running itself or you're looking to get out from under it. So over the course of this, there's a variety of different capital options, and this is just sort of a handy slide we can send out when you're looking at things to kind of reference back to make sure you're considering all of your options, whenever you're looking at doing a financing option. So 90% of small businesses, that is a completely made up statistic, by the way. It is high. I believe it's actually, anyway, almost every small business you're going to work with is going to have their personal capital wrapped up into the business for some reason. So first off, it's the cheapest way. I mean, you're spending your own money. There's no interest. You're not selling a portion of the business. So you can tap into what cash reserves you have, savings, bootstrapping techniques, which we'll get into here in a minute. And then there's some other options down there, which I'll cover here in a second. So the first bullet point on this slide, though, you need skin in the game before you seek any external funding. So what this means is, and one point which we'll cover later on with the different financing slides with loans and small business loans and SBA loans, you do need to have skin in the game. In the banker world, they refer to that as an equity injection. They're looking for how much of the overall deal have you wrapped your personal finances up into. The idea being, if we take a simple $100,000 loan, it is easier for you to walk away from $100,000 that the bank just gave you than it is to taking $10,000 out of your saving account, paying it towards that, buying pieces of equipment for the business, and then financing the remaining amount. So typically the bank's going to look at anywhere from 10 to 20% equity injection, depending on what the overall project looks like. 10% is pretty standard for this area. So just keep that in mind. Whatever your overall financing package looks like, you're going to need to account for at least 10% of that through personal funds. One quick note on that, it doesn't necessarily have to be cash, but if you have pieces of equipment, land, whatever, where you can show you've already paid those things in cash and you are using them not as collateral, but you can show where you've already put your personal equity into this business, there are options there as well. But typically these things are going to come out of personal funds, cash savings, obvious, bootstrapping we'll cover here in a second. Home equity, this is another one that's kind of twofold. So a lot of businesses will just take a small home equity loan, home equity line, to begin their small business, depending on what amounts they're needing. The flip side of that, if you are looking for financing, for traditional financing through a bank, through the SBA, those sorts of things, home equity is going to provide additional collateral. So typically the bank, unless that loan is fully collateralized otherwise, they will require you to put up some home equity as well. So whenever especially if you're seeking an SBA loan, which we will require a second on the home unless the loan is otherwise fully collateralized. So friends and family, ask around. This kind of falls into some of the crowdsourcing stuff. Crowdsourcing would be your Indiegogo or GoFundMe, Kickstarter, those sorts of things. So just kind of keep those in mind as options. Credit cards, as much as I hate them, at some point most folks have put something on a credit card to cover payroll, cover equipment, cover inventory up front. This is one of those life cycle deals to where if you're looking at this your first year, first 6 months, okay, not that big a deal. If you're 5 years in and you're still having to cover items on credit cards, other than taking advantage of X points or whatever, that's probably where you want to circle back on your business plan, kind of look at things and figure out what's going on, because at that point you really should have sort of cycled away from that and moved towards longer terms of financing or working off your business's cash flow itself. Equities and stock portfolio, I'd be careful personally on this one. Usually those and retirement accounts all grouped together. Those are usually a double-edged sword. We provide you cash today, and then at the end of the year, once you get to your filing taxes, there are some penalties that you might not consider. So I would definitely consider those last three as a last-ditch effort, if you will. I would definitely exhaust my other options before going the route of borrowing against any sort of stock or retirement accounts. So, but those are available to you, and they can help with cash flow coming out of the box, and those would fall under that personal funds umbrella. One of the items listed there was bootstrapping. If you're not familiar, what bootstrapping is, the shortest version possible is it's getting by with the bare minimum. Bootstrapping options can include, instead of getting a new piece of equipment, looking at buying or even leasing a used piece. Essentially looking at your overall business plan, the business itself, and determining, what do I want, and then what do I need, and then what can I get by with. So whenever you're talking, you want to start with the best option possible, and you can include these bootstrapping options in there in your overall project. When you're talking to a lender, talking to an investor, explain that instead of buying a new piece of equipment, you're going to lease this instead. Instead of buying say you're buying inventory, pool yourself with another business in a similar industry, so you guys get a bulk discount. Just little tricks like that you pick up from other business owners, and groups like this where you guys can network back and forth together, talk about your business, talk about your options, and share little tricks you've picked up. But bootstrapping is basically the best way to save money for your business. To sort of maximize your cash flow at the end of the month. There's plenty of options out here. We could do a whole webinar on bootstrapping, but we'll jump past this. If you have questions on this, please let us know. And then, so this is sort of the last slide we have before we get into more specifics, and this sort of preparing how to either raise debt or equity financing. Again, step one, and going back to the business plan, determine exactly how much financing you're going to need. Step two is determining what the best fit of financing is going to be. And then step three is, how are we going to market ourselves to those investors? How are you going to market yourselves to the lenders? Those sort of items, whichever option you may fit into. So whenever you're developing your a tax strategy for this, you definitely want to look at them in these three phases. Step one, business plan, figure out how much we need. Step two, look over the information, contact your different resource partners, check with your friends in this group and that have worked with other lenders, other financing options, come up with sort of what you think is going to be the best fit. Contact the SBA, ask us what questions you have, and then we'll develop, you'll develop a strategy on how to find that lender, find that borrower. So when you're trying to figure out which is the better fit for you, as far as what financing options you have, there's two large pools. There's basically two ways of looking at it. There's debt-based financing and there's equity-based financing. Debt is what everyone thinks of. It's a traditional bank loan, credit cards, anything where you're maintaining 100% control of the business. You're not selling anything as far as equity. You're not giving up any of your ownership. However, you're going to wind up having to repay these things over some amount of time while those things are accruing interest. So it's you typically consider the cheaper way to grow because all you're really paying is interest up front. And at the end, you're going to remain 100% ownership. But what you're not getting from that is if you're needing to bring someone on who has access to cash that you don't have to meet whatever the debt requirements or that equity injection, or bringing someone on who has experience with accounting, who can cover the book side or the marketing side, or any of those bonuses that an equity injection or equity financing would provide you. And on the flip side of things, equity, so it's going to involve investors one way or another, where you're going through crowdfunding, or whether you're going through, actually an angel investor or venture capitalists or something like that, where they're investing into your business. These are going to involve people that are providing you cash in exchange for some ownership of your business. These funds are typically not paid back. In some cases, such as venture capitalists or angel investors, their goal is to, get in there, help the business grow, and they're going to leave at a certain point. Their goal is to sell that for whatever amount they've managed to help you increase that along the way, and that's sort of where they make their money. So while the funds aren't paid back, there's a portion of the equity that's gone that might get sold later on. Hand in hand with that, that means you're going to have shareholders to answer to. You're no longer the 100% owner of the business, or partnership or whatever you have. So you do have additional things you have to sort of do throughout the year on that. And then bottom line, downside, you're giving up a portion of the business. Plus side, you could be bringing someone on. They're essentially their goal is to help this business grow as much and fast as possible, so they can make more money. Is sort of their goal. They're providing an investment into your business for a portion of that equity. So when you get big and you've made it, and the business is in its maturity stage, and you're bringing in the big bucks, they can then sell their portion to someone else, and then take that capital and go invest it in another business and continue the cycle. That's sort of how that equity side works. So this is something you need to look at. Debt, are we wanting to have to pay this thing back and maintain ownership? Equity, do I need to bring someone on with some more experience in certain portions of the business in exchange for their money and a portion of the business and profits down the road? So debt-based, that's the typical way of looking at it's going to be loans. So banks aren't providing any sort of they're providing you liquidity. They're not providing any sort of investment, such as they're not really invested in what happens to the business, other than making sure the business is up, running, and is able to pay their bills, which is the bank's primary concern, which is getting paid back. To determine this, banks are going to kind of run you past the 5 C's, and these 5 C's remain the same whether you're looking at small business loans or traditional loans, mortgage, anything like that. First, credit. While there is no real minimum FICO score, if you're really anything, and anything under like a 640 or so, the bank's going to ask questions. It won't necessarily be a decline, but they are going to try and figure out sort of what's going on, why that was lower than it should have been, so on and so forth. So one thing you always want to make sure is that you're on top of knowing where your credit's at. There are several avenues out there that will allow you to monitor your credits. I know I've got a credit card where every month they send me a statement of what my balances are, and if there were been any new inquiries, those sort of things. So at this point, there are services out there that aren't going to cost you anything, that will keep you sort of abreast of where your credit's at. Highly recommend that. If you have some credit deficiencies, you definitely want to address those first and foremost if you're looking at debt-based financing, or you might look at some of the equity options if you think that's going to be a hurdle you can't get over. Collateral, not equity, but what pieces of equipment, what buildings, so on and so forth, inventory are you bringing to the table to help secure this loan? Banks are obviously risk averse. And so if you're borrowing $100,000, they're going to want to have at least that much in collateral. And the way they're going to value that collateral, they're not going to look at it and go to Zillow and figure out what that piece of land's worth and go from there. they're going to look at it through, some sort of an actual review, and then they're going to lower that percentage. Typically, off the top of my head, they look at it about 70%. So even if your appraisal comes back and your home, the piece of equipment you're going to do is $50,000, they may only value that at $35,000 because the bank looks at things as a liquidation value and not necessarily, hey, this is what I could sell this under the best case scenario. Commitment, really, as far as starting off, there's two stages here as far as commitment goes. First is that business plan. If you committed the time and effort into looking at this, putting your time, work, nights, whatever, reviewing this, making sure it's a realistic business plan, or have you, downloaded a spreadsheet or a boilerplate document, filled in a couple of blanks, and then didn't bother personalizing it, didn't bother doing any research, anything, and just did the minimum work possible to check that box, so to speak. And then the other part of commitment is going to be that equity injection. Have you actually put your money into this business at this point, or is right now it just, I would like to finance the whole thing. I don't have anything coming out of pocket. So that's what they're going to review as well. Cash flow, I'll get to character in a second. Cash flow is their number one concern. Cash flow tells them, how am I going to get paid back? The bank's number one concern is that credit tells them the likelihood someone's going to pay them back. Collateral tells them if they don't pay us back, what are our options? And then cash flow tells them, here's their monthly expected income. Here are their projections. Where can we fit our loan in here? Can they actually afford this without us? And we'll I think it covers it a little bit later, but this is where you're going to get your projections and things on that business plan through working with various resource partners and making sure those things are realistic. Right now, that's pretty hard to do with all things COVID and sort of branching out into a post-COVID world and how resource partners and lenders are looking at projections. So as this is, if you have a document from a year ago, you're definitely going to want to reach out to someone, update your information, and make sure all that cash flow is still viable and realistic. So the last one is character. So here they're really looking at, for our points, really a sort of like a criminal background or sort of any sort of negative feedback or anything. If there's some reason you've had issues with the bank before, it's really harder to quantify than the other one. So that one's really more of a case-by-case situation, which you can look at with the lender whenever that comes across. Now, whenever you're looking for a lender, the SBA, we actually have a pretty good option. If you go to our website, it's sba.gov, there's a program out there called Lender Match. That will put you in touch with any lender in your county or any contiguous county that participates in our 7A microloan or 504 programs. They have no requirement to use an SBA program. They can fund this thing traditionally and not have to use any of our programs. It's just a way for us to provide you an easy way of getting in touch with the lender. And then whenever you are at that point where you're ready to talk to a bank, definitely start with whoever you have your accounts with first. They have more of a personal relationship with you. Most lenders are going to require some sort of a depository relationship on the loan side, so that's already in place at that point. And then if you're looking outside your regular lender, focusing on community banks and credit unions, these can be some good options. Typically, in my background, I worked for some larger banks when I was younger. Those look at things at a more corporate view. The bank in particular I was working with primarily, we'd put a loan project or put a loan together. We'd send it off to their headquarters, which was 10 states away. They would review it and then come back and let us know what their thoughts were on it. As to where if you're dealing with, First Community Bank of somewhere, Oklahoma, that may be their only branch. You're actually talking to the people that are going to review your loan. So there's no need to try and explain things in such a way that, you're going to explain it and play telephone where you explain it to one person that's going to go, 3-4 people down the road before they actually get to the committee that's reviewing your loan. So always a good option to stay local, always a good option to stay with some of the smaller community and credit unions because they are a little more understanding and easier to work with.
Hey, Dustin. Had a quick question from Steve here that says, are there currently any loans for service disabled veteran-owned businesses at this time? Do you know that answer off the top of your?
I do. So technically, right now there is still, and I just know through the SBA, there's a loan called the Veterans Advantage Loan. I will tell you right now, with the stimulus package that was passed back in December, the Economic Aid Act, it sort of trumps the Veterans Advantage Loan. Typically, a Veterans Advantage Loan, what that gains you through the SBA is if you use a certain one of our programs, which is called Express, it waives the guarantee fee. It doesn't provide any additional approval bonuses, but there's a guarantee fee that's paid up front. It's usually several $1,000s. For veterans, we waive that fee. However, with the Economic Aid Act, they actually waived that fee along with several other bonuses for this year. So we have the program still, but for right now, the regular program essentially provides the same terms. However, once we get back to October 1st, those bonuses go away for everyone else, but veterans will still have a waived guarantee fee whenever you're applying for an Express loan. As far as other agencies go, I don't know off the top of my head. I know one of the common questions we get outside of just, what veteran specific programs do we have, or what grants do we have? And unfortunately, through the SBA, there are no small business grants outside of disaster loans, which a lot of folks have worked with the different COVID programs, such as the Paycheck Protection Program, the Economic Injury Disaster Loan. Both of those have some sort of grant aspect to them. Really, on that disaster side, that's the only place you're going to find any sort of grant funding. Typically, you're free to go through grants.gov and look for things. There may be some things out there that I'm not aware of, but through the SBA directly, there aren't grants even for veterans or service disabled veterans. What we really have is just that Veterans Advantage program, which waives those fees for you guys. But again, those are all waived through the end of this year anyway. However, starting October 1st, you will continue to still have those waivers where everyone else will go back to paying the fees. Does that kind of address the question?
I think that probably did, Dustin. I certainly appreciate that.
Yeah, and unfortunately, I'll get to the questions here at the end, and please feel free to interrupt me because I am tabbing back and forth to get to my slides and things. So I am sure I will miss questions, and I will try and address them at the end. Or again, feel free to sing out, and I will try and get them in row. So now, so I just kind of explained part of this. So the SBA ourselves, we have what's called a guaranteed loan program. Primarily, this is handled through our 7A and our Express programs. We don't directly lend money. The only time the SBA directly lends money is through a disaster program, which is typically either the economic injury disaster loan or we have a physical disaster loan. Everyone's really familiar with this now because we've been in the news because there was a ton of money made available through the EIDL or the EIDL or the economic injury disaster loan through COVID. That program actually remains in place. If your business is already in place and you haven't applied for an EIDL loan, you have until the end of this year to keep applying for those, just as a side note there. However, the requirement is the business would have to have been in business prior to the start of COVID. The date they use on that is January 31st. But for the actual loan programs we have, we don't actually provide the money. We don't fund them. The only time the SBA gets involved is through the approval process. And then if the loan were to go bad, we work with the lender and things on some workout options. What we do is we provide a guarantee, which if you want to think of it as insurance for the bank, say for simplistic terms, say the bank's looking at giving you a $100,000 loan. For some reason, let's say you're a startup. The bank is just risk adverse to startups. They won't do a startup without an SBA guarantee. The bank normally would not approve your loan. However, they can apply that guarantee, which depending on which program, what size you are, is anywhere from a 50% to a 90% guarantee, which sort of alleviates the fear or mitigates the risk the bank has. so they can actually go out and make that loan to you. So when the bank's reviewing your loan, as far as their risk, even though you're talking about $100,000, we'll use the Express program for a loan that small. They'd be using, a 50% guarantee in that case. So even though they're, financing and earning income, interest, and providing the loan for $100,000, they're only at risk for half that amount because the SBA will cover sort of the other half of that. That is primarily how most of our programs work. We're essentially just providing insurance to the bank. So if there are loans where they want to get that deal done and for whatever reason they can't, again, startup and not enough collateral are our primary reasons, they can put that guarantee on there, mitigate some of the bank's risk, and then continue with the financing. From the borrower side, the bonus to this, you just got access to funds you wouldn't have normally had. We do place some limitations on sort of what the borrower, or what the lender can charge, as far as there are origination fees because we have the guarantee, guarantee fee. We place caps on what the interest rates are. We don't subsidize the rate, but we do place caps on what they can charge to make sure they're not gouging, essentially. But we're also making funds available to a borrower that normally wouldn't have had access to that because the bank would have deemed the loan too high of risk. So a few statistics here. About half the banks in the U.S. do participate in the 7A Guaranteed Loan Program. This number is pretty out of date. This particular slide deck predates COVID, so we've had quite a bit of interest after our big disaster loan programs have kind of wound out. So we're seeing more and more of this. So if you're curious about the area where you're at, contact the district office, go to that SBA.gov, look at lender match. Anybody that participates in the program will have access to those to be able to get back with you. So the program operates through private sector lenders. Already stated that. So traditional banks, credit unions, things like that. Those who actually are funding the loan, those are the ones that are providing your capital. We just have that guarantee piggyback onto it. It still requires you do the traditional 5 Cs. There are some additional stipulations. Just like banks, we don't have like a regular minimum FICO score or anything, but you're going to have to still address whatever the issues are if there are some low credit issues. The only difference is loans where we have placed a guarantee do have to go through what's called a credit elsewhere test. Basically, the bank has to explain to us why they're placing the guarantee on there. They can't just put one on for no reason. They do have to tell us because it's a startup, because it's this. And there are certain things, for instance, we use credit again because it's a common question I get. They can't use the guarantee to offset a credit risk. So if the FICO score doesn't meet their minimum requirements, that's something they couldn't use the guarantee for. If you didn't have enough collateral, that's fine. Anything like that, that's fine, and other issues as well, increasing loan terms. But there are certain things that we can't be used for. Now, size of the loan, I think I'm kind of running a little bit long here, so I'm going to kind of speed things up a little bit. So pretty much all of our small business loans are eligible for any legitimate business purpose. I have seen loans as low as $1,500. I'll admit those are rare, and our loans cap at $5 million. And I've seen things in between for a variety of reasons. That $5 million cap is aggregate, so you can have multiple loans up to that $5 million cap. But there really is no minimum. The bank is more concerned as far as how much you're borrowing and what that means to them as far as the guarantee percentage. But just so you know, depending on, if it's less than $150,000, the bank qualifies for a larger guarantee percentage. If it's over 150, it drops down a little bit. If you're doing any sort of exporting, we have various export programs to increase that guarantee percentage further as well. So sort of what can you use the guarantee side, the SBA guarantee loans for? Again, pretty any legitimate business purpose. You can use us to stock shelves. You can use us to buy equipment. You can use us to buy large pieces of land, to build, startup costs. Pretty much any reason. And the caps says on here, loans are capped at $5 million. The funds do have to be used for small business needs. Now, we do run into some situations where someone has financed part of a small business on a credit card or something. As long as you can, even if it's a personal credit card, as long as you can prove those funds were used for business expenses, you can go ahead and include that in a refinance, or include it as part of your overall loan package. You don't have to have one loan for the build out, one loan for the inventory, one loan for working capital. You can combine all those into one. And then if you have put some things and run yourself a little tight on credit cards or something, as long as those were used for business purposes and it's provable, you can include those as part of a refinance portion of the loan as well. Three major programs we have. 7A, this is the primary. Again, so let me preface this. Whenever you go talk to the lender, you're just going to go in and ask to apply for an SBA or apply for a business loan. The first thing they're going to try and do is apply for the loan, approve it without an SBA guarantee. If for some reason they can't approve it, the bank is then going to look at applying an SBA guarantee onto the loan. You don't need to know which particular program it is. You don't need to necessarily go in and request a 7A or a 504 or an express loan. The bank should know which program would be the best fit for you. Like anything else, it doesn't hurt to have that knowledge, but you also don't want to get hung up on trying to get the, I want this particular nuance of this program. Just discuss all these things with your lender. They should go over what all of your options are if they're looking at the 7A side of things. So the main programs we have are 7A, Express, and then 504. 7A is pretty much used for any business purpose. You can use that for working capital. You can use it for inventory. You can use it for pieces of equipment, what have you. Express is really SBA light, or sorry, 7A light. It is a simplified process. They actually get a smaller guarantee for this, but the trade-off is right now it's a month to even get your loan in front of a SBA loan officer to get it reviewed because of the amount of activity we have right now. With Express, there is no SBA review. The bank is the one that handles all the underwriting. They would be the one that would handle all the inputs. They would generate all the SBA documents. There is no lag time. It's an instant approval through the SBA. So those are smaller loans. Actually, for this year, they're raised to $1 million, just as an aside, which is set to go back, as I mentioned, with the Veterans Advantage program at the beginning of the fiscal year, so October 1st. So the last program, which I don't think is listed anywhere on here, is it? No, is the 504 program. 504 lending is fixed asset. So this is really if you're just looking for large pieces of building, large buildings, build out, large pieces of equipment, things along that line. That program is pretty limited, can't cover a lot of working capital needs, pretty restricted as far as that stuff goes. Really, if you're a startup and you're looking at the 504, you're probably looking at some sort of a hotel or something like that where there's a large expensive build out process, but whatever you're doing is going to be primarily fixed asset. So you'd look at doing that 504 loan. Again, when you talk to a lender's going to know all these things. They're going to know the proper program to put you in. And it may wind up that you do, part of your loan is a 504 for the build out and for the, the equipment you're purchasing. And the working capital portion you do on a 7A. Every one of these is, sort of individual and it's looked at differently, and there's not really a blanket answer that X loan is best for you if you're under Y cap and you're in Z industry. So there's so many different things in there that you really want to talk to that lender, have that conversation, have them review your documents and go over those things before you throw your weight behind one of these options or the other. Few other small programs here. So these are all administered through nonprofits. They're part of our underserved markets division, but activities. One is the Community Advantage program. It's pretty similar to 7A Express, but it does have a smaller cap, and it's less stringent as far as the credit requirements. Typically, those nonprofit lenders have additional options beyond just what a regular 7A lender can look at. And then the other one is going to be microloan. Microloan is for loans that are $50,000 or less. It has some alternative approval methods as well. Part of it is what's called technical assistance. So these are programs to where, as part of the thing, you're going to apply, you're going to give them your business plan, you're going to go over what you want. And then they're going to schedule you for, 2 hours of training on business finances, or they're going to schedule you for an hour of updates on, IRS programs for this year. But they'll have some sort of an ongoing training program where both you and the lender are required to meet certain certain goals as far as providing technical assistance. So beyond just obtaining money, this provides you with free training on certain aspects of running a small business, which can be helpful. The goal in both these programs is, say you've had some issues in the past, or for some reason you can't qualify for a regular loan, it still gives you a path forward with that funding and the training designed to put you in the position to, when those loans mature, to look at doing more traditional 7A or 504 financing. So common question we get, what's not eligible for SBA financing? Again, we'll run through this real quick. So gambling or speculation. Common one we get here in Oklahoma on the spec side is wildcatting. So if you're looking at the gas and oil industry, if it's established wellheads, we can do it. We can't do any sort of wildcatting. On the same thing as far as spec goes, we can't cover the R&D portion of any sort of project. And then we can't do, like, if you're a builder. If you're doing a custom build or something like that, we can provide some line of credit options. However, if you're just buying this lot, putting in 20 spec homes and hoping they sell, we can't help with those. Gambling. This really runs into things as far as casinos goes, which that's not really a concern for us. However, if you're doing like a gas station or something and they got the scratchy lottery tickets, the gambling, it does have to be a significant portion of the overall income of the business. So typically those aren't going to be an issue. I already covered the real estate investment. That's that spec I was talking about a second ago. Lending activities aren't relevant. Multi-level marketing firms. So if you're doing the, Mary Kay or Arbonne or XYZ fitness drink or whatever the current thing is, we can't participate in those. Businesses providing sexually prurient material, can't do those, like your Christie's toy boxes or gentlemen's clubs, things like that. We can do like traditional bars and things, but if there's a sort of a sexually prurient aspect to it, we can't touch those. Religious organizations, just to be clear, we can't do a specific religion. Now, if you have a theology bookstore or something where you sell a variety of religious texts or something, we can do some financing on those. What we can't do is a specific denomination, or, we only deal in Christian-based textbooks or something like that. Nonprofits. So with our disaster programs, this got waived for a lot of them. However, for traditional SBA financing, you still can't do any sort of nonprofit. Same thing with charitable organizations. They kind of fall under the same umbrella there. The big one from Missouri. Sorry, I'm from Missouri, and I was there this weekend, so I keep thinking that. For Oklahoma, is illegal activities. So in Oklahoma, obviously, the one everyone asks about is medical marijuana. State-wise, there's some legalized aspects there. For the federal programs, though, it's still federally illegal. So you can't use any SBA financing, even if you have a piece of equipment and you're subletting, piece of land, you're subletting part of that land to a grow operation or a dispensary or something. They won't approve for SBA financing. If you're doing CBD and it's non-THC based CBD, there are some options there. But just keep in mind, if that's what you're doing, great, good luck with that. You just can't use the SBA programs for that unless laws change down the road or something. And then borrowers who have defaulted on federal loans or financing. So one of the things that get checked is a program called CAVERS. Basically, it's a credit report for federal financing. So if you do have an old student loan that's charged off, or a VA loan that's charged off, or something like that, be prepared to address that. If it's something you can take care of, bring current, put on a payment plan, there may be some options. But if it's defaulted, that could keep you from getting any sort of federal financing. That's not just SBA, that's across the board. There are some other programs that kind of run alongside us, especially here for Oklahoma through the USDA. Not going to go into this too much for no more reason than I really don't know all that much about the USDA. I know they have some additional grant programs and some traditional lending programs as well. They work on some larger things, so we're capped at $5 million. I don't believe they are. I think they've got some other alternatives there, and their programs have some different things to track as well. But there are several government agencies when you're looking to finance a small business. Obviously, the best one's the SBA, but you've got USDA, you've got FSA, you've got HUD to some extent. Tons of different options out there. So, make sure you're kind of checking everything out. Make sure you're talking to everyone you need to talk to whenever you're looking at that financing options to make sure you're getting in the right overall projects. Advantage for going the government loan. So, I don't think I should cover disadvantage, but I'll cover it in a second. So on the bank side, it mitigates their risk. So they're able to make a loan they normally would have had to decline because the loan would have been too risky. On your side, it allows you to obtain a loan that you wouldn't have normally been approved for. It does place caps on sort of what they can charge as far as interest. It provides some longer repayment terms. For example, traditionally banks can only go out 20 years on real estate. They can apply an SBA guarantee to these, and that program can go out to up to 25 years. The cash out of hand, cash out of pocket, the equity injection I mentioned earlier on, that's typically 10%. It could be up to 20%. Our programs have that minimum of 10% requirements. Typically, they will just go with that minimum, even though they might charge something for a non-guaranteed loan at a larger amount. And then the last one, and a lot of folks don't think about, is no balloon payments or no demand clauses. If they have our loan program or any federal loan program for that matter, balloon payments to where you're only paying interest, and at the end the note comes due and you've got to refinance or pay the whole note off. You can't do those with us. It does have to be on an amortization schedule, a full amortization schedule, to where that loan will get paid off at the end of the term. So it keeps you from, the bank calling the note at the end of the month because, your credit's gone downhill or something, and now you won't qualify for refinancing that. So it kind of keeps those gotchas from getting in the mix as well. And that falls in with the lower interest rates and longer terms, trying to make things as easy as possible for the borrower. So that's sort of the debt-based financing side of things. That's the traditional go to the bank, ask for a loan, pay the loan back, and you get money. The other side, which we will, I just realized how far I've gone over, we will kind of breeze through quite quickly, which is equity funding. So the most common one everyone run into right now is crowdfunding. It was just made illegal back in 2012. Prior to that, it wasn't. This is, you've seen Kickstarter, Indiegogo, GoFundMe. There's about 1 million of them if you go out and Google them. And I believe there's some veteran-specific ones as well. This is where you're basically asking people to provide certain amounts of money for your business. I guess the positive side to this is, you're casting a wider net, but you're not really giving up ownership. To the best of my knowledge, and unless something's changed, there is no ownership exchange possibilities. All you're giving up is, say you're owning a brewery. If you donate $1,000, you get to name one of their beers. Or say you're starting a golf course, you get your name on a plaque or something somewhere. There are bonuses for investing in these things, but really you're looking for someone that's passionate about what you're doing or what you're doing in your area. Say you're working on a certain, add-on for a device or something. You're going to look for people that work on those or use those devices because they find what you're trying to do will be beneficial for them down the road. So this is the easiest, I guess, cheapest way, if you will, to look at sort of any sort of equity financing, because you're not really giving up ownership of your business. However, you are going to have, most of these places require you to answer to the crowd or to who's financing this, at least until the program is up and running. There is no guarantee it will be, but you do have to answer to those investors through quarterly or monthly updates. Angel investors, these are typically people who are towards the end of their career. They've accumulated some wealth. They're trying to pass that information back on to borrowers, onto new entrepreneurs. These things have blown up recently. They've become quite bigger. I don't know right now in the post-COVID world how these are going to pan out, because there's not been enough information released on them. But up until that point, These are the people you're going to bring on, I mentioned earlier, who have experience in a similar field, who can help you kind of navigate some of the pitfalls. And their goal is to go in there, help you grow as quickly as possible, be in that business for 5 or 10 years, and then sell it, and then keep doing that on their side until they work towards a retirement or something. So they're directly injecting their cash into your business. So they've got obviously a pretty big incentive to help you succeed. Trade-off is you do have to answer them. You do have to work with them. It's no longer just your business. The larger version of this would be venture capitalist. It's the same general principle. However, instead of being individuals or a couple of people, now you're dealing with essentially groups of people that have invested into different funds that are applying these to multiple different businesses that are requiring a significant growth. They're looking for as much growth as possible. They're far more specific than doing a traditional, it's not traditional, it's doing a angel investor, anything like that. They're sort of the corporate version of that, if you will, to where they're definitely looking at this as a business thing. They're not so tied up in the nuts and bolts and things. They're just worried about the bottom line at the end of the day. So they still will have requirements, but the angel investors are the ones that are going to work more with you on sort of helping the day-to-day questions and things. As you get larger, these aren't going to be things you'll have to deal with right now, but as your business grows, you'll have additional sources of equity. You're not going to see much in the way of venture capitalists as far as startup goes. It's primarily going to be angel investors. But you will see some venture capitalists are really for that midpoint in your business cycle. And then as you get larger, you're going to see private equity, private placement, and then taking your business public, if you will, your IPO, and then trading on the stock market and such. So those are larger equity options down the road. They're not really things you're going to worry about up front, but they are things you should kind of keep in the back of your mind as options down the road. So key takeaways, whenever you're looking at these things, don't just plan for today. Make sure, obviously day to day, that's what everyone's concern is up front. That's the hardest time. Unfortunately, you need to look at down the road. So even though you might be able to make it work right now, make sure through that business plan, through looking at your business, that you have planned for growth, that these funds are going to be something that helps you down the road, and it's not just a stopgap. Obviously, you're going to have issues that come up, but if you keep running into stopgap after stopgap after stopgap, take a look at things, figure out what's going on, have someone put a second set of eyes on your business plan, go over things. Other thing to keep in mind, there's a ton of different options out there. So whenever you're getting serious or looking at these things, everyone thinks, how do I finance my business? Their first thought is, well, I go to a bank gives me money. There's way more nuance than that. You've got federal agencies, you've got lenders, you've got your own capital, things you wouldn't have thought of using. These equity investments or equity investors, plenty of different options out there. Same side, say you've got some issues. You're probably not going to qualify for some reason, a recent bankruptcy or something. That's going to take debt-based financing off, but you know what? You still got the equity side. You got plenty of options over there. So knowing sort of what options are out there to make sure it's the best fit for you. And then knowing how much control you need to keep. Do you have to have 100% of your ownership? Is it going to benefit you to have a 15% owner that's brought cash to the table and can provide some experience in your particular field? Weigh those options as well. And then finally, understanding how much you need. This is something you should work with your resource partners. Look at your business plan. That thing should update at least a couple times a year, and you should know exactly how much financing you're needing. So when a bank asks you, you don't just say, well, I heard this loan goes up to this amount, so I'd like that amount. You can tell them, hey, here's my list. Here's the things I need. Here's where my money's going. What can you do for me? How can you help me? So we'll skip over this one. There are financial statements you're going to be required to provide, investor or lender side. So if you're going equity or debt based, let us know when you get to that stage. We've got people that can help you with that, different resource partners, SCORE, SBDC. They'll help you come up with those projections. Plus, right now projections are basically impossible with the COVID. Well, not impossible; they're difficult because of the COVID world and understanding where things are going to be at, which has sort of increased the activity with federal programs because we alleviate that risk to where they know up front they're taking a higher risk because of the issues we have right now. So they can place those guarantees on there so they can still provide the funding, still help the entrepreneur, and the bank can still get it past, you know, their review board that justifies why they made the loan. So here's my contact info. I think that's the last slide. So yeah, I'm going to leave that up and take a drink of water because my throat's super dry. And I know I ran a little bit long there. So if we have some questions, I will be happy to answer them. Let's see. John sent me some stuff, which is not you guys. And
I think we've answered the questions that have come up. There hadn't been very many, Dustin. I'm sure that once more people watch these videos too, there may be some more questions that come up that either you or I can address with them and get them that information that they need back out there too. So.
Okay. And again, any questions you guys have, my contact information is there. Yeah, my email's there at the bottom. I will. I'll give you my cell phone as well. I'll type it in the chat because my office phone works about half the time right now, and I don't see an option to type it, so I'll just give it to you. It's 202-805-9178. 202-805-9178. That is my office cell phone. That 405-609-8017. That's my. It rings at my computer now. I can be reached at either of those. We are pretty busy right now with all things post-pandemic. So if you don't get a hold of me on the phone, leave me a voicemail. I'll get it returned. If you send me an email, I can usually get to those a little bit quicker because I am on quite a few conference calls and things, and I can respond to those during those. So again, if you have any other questions, please feel free to call our office. Give me a call. Give John a call. And let me know if there's anything more I can do for you guys.
Did I get the number right there, Justin? 202-805-9178?
That's it. Yep. Thank you very much.
Well, thank you guys for being here. John, did you have anything you wanted to say before we signed off too?
I did. Just to close up what Dustin's covered for the last hour, I want to make sure you take away some key points. I think one is be prepared to invest your own funds. I mean, no one is going to fund you at 100%. So be prepared to invest your own funds. Secondly, you need to build a banking relationship. You can't just walk to the bank and the first thing you say is, I need this major loan. Make sure the banker knows you and you built a relationship. Thirdly, and Dustin touched on this again, financial statements and tax returns. Make sure those are current. Make sure you're doing that if you want to get financing. Credit history does matter. If you have bad credit, that does matter. That can have an impact on your ability to get funds. And last but certainly not least, as you do your projections and you do your list of what you need, be realistic. Don't give a banker a projection that says you're going to be making $1 million in the second year of business. Those kinds of things. Be realistic in what you're doing if you want to get those support. And those are just some five final tips for you to remember as you go forward with this venture. Other than that, come to SBA and we'll do what we can to help you out.
Awesome. I certainly appreciate you guys being here to help us out with this class today, and hopefully we've stemmed some conversations for others on what they need to do for loans or other means of financing, and that's our goal. Anything you need, just give us a call over here at the VA or give them a call over at the SBA, and we will help you out whenever we can. And the contact information again is on the screen for the general overall contacts. So I think we're going to sign out for the day, but hopefully you have some more questions come up and we'll get those answered as soon as we can. Thank you guys and have a great day.
You do the same.
Thank you.